Welcome today to Meet Our Founders, our series of episodes where we interview some entrepreneurs who share their experience, the challenges they are facing, and advice they can give to other founders. Today, I'm glad to be with Sanskar, who is co-founder of Capitall. First of all, we would like to know more about you, so can you briefly introduce yourself and your startup Capitall?
Sure, Jim. Thank you so much for having me on here. To start off with an introduction, I'm Sanskar, CEO and co-founder of Capitall. I'm from Bangalore, India, and I've been part of the startup ecosystem in different capacities over the past 6 years. Prior to Capitall, I was part of Entrepreneur First cohort in India, which is where I met my co-founder and CTO, Pranav. Although I'm an engineer by education, I've primarily spent my time with payments and lending startups in business and strategy roles. Now, to introduce you to Capitall, we've actually built a platform that enables small-scale businesses bridge their cash flow gaps by crowdsourcing short-term business loans from common folk. We're the first platform in the country to make this asset class accessible to retail investors and therefore build a gateway for them to directly lend to businesses. It's been about 6 months that we've launched and have already disbursed over $100,000 in loans to multiple businesses, all of that funded from our community of investors. So that's just a little bit background about myself and the company.
Thank you very much. So what inspired you to start Capitall?
Right, so businesses was something I always knew I wanted to pursue. I myself come from a family of generational businesses, and in my household itself, we've got 3 businesses, from manufacturing and distribution all the way to restaurants and catering. So surrounded by these businesses all my life, I was also surrounded by banks and their never-ending SOPs for working capital loans. I realized quite early on that even profitable businesses that have been around for years do not have quick and easy access to cash. And seeing that problem firsthand, I decided that there has to be a better way to solve it. Given my experience in the fintech ecosystem, I knew that there were specific data levers that we could use to solve this problem at scale. And that's when I knew that, hey, I've seen this problem firsthand for so many years. Why not go out there and solve this for not just my family and myself, but millions of other business owners out there? So that was my inspiration and motivation to start Capitall.
You spoke about the problem, so let's dive a little bit more into it. So what problem does Capitall is trying to solve and why the problem is important?
Right. So Capitall is trying to, in simple terms, Capitall is trying to solve a working capital gap that businesses face. Now, to give you a small background on this, in India, 84% of SMEs or businesses do not have access to formal credit. India today holds one of the largest credit gaps in the world. And this is primarily because traditional lenders don't look at small-scale businesses as a scalable avenue. This leads almost 60 million businesses in India to borrow from the unregulated sector in the form of friends and family, HNIs, or loan sharks. Now, since this sector is unregulated, it's filled with malpractice and exorbitant interest rates. Working capital, in essence, is critical to any business's operations, small or big. Your short-term cash flows to either pay off accounts or to stock up inventories, increase SKUs, or just manage your OPEX costs is super important for any business to run. And this is capital that is generally not planned for. So there are 2 types of capital when you look at SMEs. There's working capital and there's growth capital. Okay. Working capital, in a sense, is ad hoc in nature. If I will realize today that probably in 10 days, I'm going to need some money to manage my cash flows. Growth capital, on the contrary, is something that you typically plan for. It's something that you either need to expand business, buy new machinery, buy land, etc. And that's something that you can plan probably 6-12 months before you actually need the money, which gives you plenty of time to actually go to different banks, find the best interest rates, and then plan your loans accordingly. But working capital is not like that. You need a partner that can help you with quick and flexible loans, and that's where Capitall steps in.
Really interesting. How does your solution differentiate from existing alternatives?
Right. So when we take a look at the existing alternatives in the market, um, there are a lot of players that provide working capital loans, but the target demography of these players is quite different. For traditional lenders, may it be banks or non-banking financial entities, they typically look at enterprise clients that have a good vintage that can take large ticket loans and for longer tenures. Because then, when you convert one of these clients, you know that your interest that you're going to make is consistent over the next 2 to 3 years. Which is why traditionally most of these lenders overlook the small scale businesses where you need short ticket capital
Okay.
for super short tenures. And since traditional lenders are not looking at that market, that's basically our target demography. We basically offer short term capital with no stress of long tenures. We offer true flexibility to these business owners. And unlike any other platform in the country, business owners actually raise capital not from a bank, but actually from retail investors. So it gives them a lot of avenues to also expand their brand and provide, and basically the platform would act as a new leverage for them to increase their brand presence amongst the community.
Okay, really interesting. So see, if I sum up, the other competitors are focusing on growth capital, as you told us, and you, it's more working capital, so short-term capital. Okay.
Right.
Let's move
It's
to, yeah, yeah,
Yeah, sorry. No, I was just saying that it's not just that they're focusing on growth capital. There are banks and NBFCs out there that do provide working capital, but the problem is that the underwriting SOPs of a bank or an NBFC is still quite manual. Most of them rely on manual processes and
mm,
age-old credit policies to actually vet these businesses, which means that they don't have the efficiency to gauge a business beyond its credit score. So, to give you an example, if there's a business that is an NTC, which means new to credit, or if there's a business that does not have a massive or a great credit score. Now, a
yeah,
good credit score does not always translate to a good borrower, as we have seen statistically, right? So, what we do instead is not just break down a term loan into a smaller tenured loan, but also use an ML model at the back end to gauge financial trends in the business, which helps us underwrite these businesses without actual dependency on credit scores. So that way, we are able to cater to businesses that nobody else will cater to.
okay, nice. Let's move to the next question, which is about risk mitigation. So you offer borrowing services for startups and growth companies, but we know that startups have limited cash flow. So how do you ensure that your users get their money back?
Right. So now the underlying structure for a retail investor today is non-collateralized loans, which means we don't take property or any assets as collateral to underwrite these loans. It's completely non-collateralized. Now, in non-collateralized loans, it's very important for us as a platform to ensure that risk mitigation is our topmost priority. Because although the liability of risk is on the retail investors, for us, it becomes super important uh, to have to have a platform that provides our users with the best user experience. So, in terms of risk mitigation, we basically have divided it into three categories. First off, we've got how the underwriting works, how we basically vet businesses. Second is the structure of the loan itself. And third is how we collect capital back from borrowers. Now, in the first category, where we have underwriting, just like I mentioned earlier, we do not follow manual underwriting processes because if you can probably envision, since we don't do large ticket loans for long tenures, our interest that we earn as a platform is quite small.
Mhm.
Which means that for us to actually have a scalable business, we need to play on volumes. We need to
Okay.
ensure that there are a lot of businesses coming in, taking a lot of loans again and again, right? And for this, we cannot keep linearly scaling our credit team basis traction, right? So we knew quite early on that we had to bring in some automation and technology in the process. So our ML model today crunches over 800 parameters in financial statements that we receive from these businesses. Now, comparing a business loan to a retail or a personal loan, the business loan has statistically more data points. because it's not just bank statements that we collect, as opposed to bank statements of an individual. It's also reports from the government, audited financials, and also the tax filings. And because of this, we're able to have a more comprehensive outlook of how the business is performing. And basis this, like I mentioned, financial trends in the business to find out if there's any seasonality, how much average bank balance these businesses have, which gives us a good idea of how the business is going to perform with its loan. So that's the first part on how we underwrite, right? The second part comes on the loan structure. Now, statistically, any startup or small business can go belly up in, say, 9 to 12 months, right? Statistically. But it's very unlikely to do so if the business is performing well for the past 3 months. And in the next 3 months, it's very unlikely for that business to go belly up. So instead of providing a term loan like how any other traditional lender does, we actually break down that term loan, which is typically 24 to 36 months, into a revolver loan. Now, a revolver loan is technically the same big ticket loan, but broken down into many small tranches. Now, this gives us a two-pronged benefit. For the business, they don't have to take a large amount of money into their bank accounts and then pay additional interest on sitting capital in the bank. They have complete flexibility on how much money they need each month basis their own cash flows. And for us as a platform, since we're not giving a term loan anymore, we just have to worry about the business paying back in the next 3 months, 3 to 5 months. So it gives us a very good visibility into the cash flows or projected cash flows of the business and reduces the probability of that business defaulting. So by doing that, we mitigate risk to a large extent. And also for our retail investors, they start making their returns 4 weeks from the time they start investing, which means they get a part of their investment back 4 weeks from their time of investment. So as the months keep rolling by, their capital and risk exposure at any point in time reduces. So therefore, we also mitigate risk like that. And the third thing is, of course, collections, right? Any lending business in the end becomes a collections game. It's about how can you get money back from the borrower if the borrower is not willing to pay back. So in our case, since it's business loans, we actually have e-NAShes or PDCs, which are post-dated checks, placed on multiple bank accounts of the business, which means that whenever we see a red flag, we can auto-debit all of these bank accounts. So therefore, it gives, whenever we see anything going wrong with the business, we just have to hit one trigger on our back end and the money is automatically debited from the borrower's bank account.
Okay.
So these are some of the ways that we protect our community.
Let's move now to another topic, which is your entrepreneurial journey. So what were the biggest challenges you faced while building Capitall, and how did you overcome them?
Right. Thanks for asking, Audrey. I believe being in the fintech space, we mostly choose problems over peace, right? I believe in India, there are multiple facets of running a fintech business successfully, all the way from compliance and legal to operational efficiency. All the boxes need to be checked out because the margins that you work on are really fine. So you have to try and ensure that your leaks in your margins are minimal. I mean, some of our biggest challenges were on how do we survive the next 12 to 24 months with minimal funding and yet be able to execute. That, of course, is a much longer story and one that I'm sure every founder watching could relate to. But I could probably tell you about one of our earlier challenges. With our business, we had a classic chicken and egg problem. I mean, that comes with any kind of marketplace. We've got businesses on one side and we've got investors on one side. Now, the problem was having raised not a lot of capital, it was critical for us to figure out which part of the business do we have to focus on more. Should we put our limited bandwidth on selling to borrowers or marketing to investors? Or should we, instead focus just on getting on supply? So what we decided to do was a small A/B test. We actually pushed out 2 LinkedIn posts spaced about 3 days apart. One post was towards businesses, telling them how borrowing should be made simple. Basically, this is what Capitall is doing, how we may be able to add value to you. And at the end, it was this DM to know more. We did the same post with investors and, of course, changed the content to tell what we're doing for investors. Now, the agenda of this test was to have an unbiased analysis on which demography is actually harder to convert. Now, with data, we realized that we proportionately received 3 times higher number of questions from the investor side as we did from a business owner side. Now, for many people, this is quite obvious. Businesses, of course, need money and hence will obviously easily convert. But our tests not only helped us identify which side of the marketplace has a larger pull, but also helped us identify the intensity and positioning of the product. We realized firsthand how important customer development was before building, and because even apart from validating your thesis on problem and solution, customer conversations can offer so much more. And with the lessons that we learned from these conversations, we were actually able to devise optimal sales strategies for businesses and build organic growth levers for investors. So therefore, we were able to strategically solve our chicken and egg problem by putting exactly how much amount of bandwidth we needed on each side. And to date, thankfully, we've never had to have a problem wherein the demand is more or the supply is more and we have an offset. So luckily, things worked out for us.
Interesting solution. Now, what are the most valuable lessons you have learned as a startup founders?
Right. I believe this journey has been one of the most exciting and educating paths that I've ever taken in my career. To probably extract a couple of lessons that I have learned, the first thing I would say is patience is everything. As a first time founder, you are bound to stress about most things. Your eagerness to build and validate actually turns into an obsession, and obsession is rarely patient, right? So for you to be seasoned in your thought process, I believe it's very important to realize that things cook in their own time. Whether it could be answers from investors, validation from customers, or even motivation from employees, they may all take their own sweet time to come through. So I believe it would bode a founder really well to be able to relax their mind, continue doing the great work they're doing, and just trust that answers will come soon. Because I believe patience would actually put you in the right mindset to perform better at work. Apart from this, I believe the other learning that I have firsthand seen is that the founder community is truly special. Um, Whether it's hiring, mentorship, or even partnerships, I believe the founder community has proven to be one of the strongest assets of the startup ecosystem. I believe the camaraderie that comes with relatable experiences founders go through, it actually evolves to a point where you'd want to help someone with zero expectation of anything in return. So for any person who's just starting out on their entrepreneurial journey, I'd highly recommend using this network to capitalize your outcomes. So yes, these are two of my learnings.
Is there anything you would have done differently in hindsight? It could be around bootstrapping or fundraising, I don't know.
Right. There are a lot of things you prefer doing better in hindsight, but I think that's just a knowledge. That's just a knowledge bias, right? So to be honest, I don't have any regrets in the decisions that I have made or the team has made. Whether it was good, bad, or ugly, because these were all experiences that you learn from and only make you better. But one thing, actually, two things that I would actually change was one is I believe that for as long as you can delay fundraising before you have actual users or proof of concept, you should do it because the problem is that with fundraising also comes inherent direct or indirect pressure from investors. And when you're very early on in your journey, and this is even before you have a customer on board, your thesis is actually very loosely held. Pivoting becomes a day-to-day activity. Figuring out what your product can do becomes a journey that you need to go on. So when you bring on an investor so early on, your willingness or pressure to execute becomes quite high. And because of that, you're not able to actually truly learn about your customers or the actual problem that you're trying to solve. So I believe to put on a good foundation, you should delay fundraising as much as possible. And once you've got a proof of concept, once you figured out that, hey, I'm actually able to drive value to these kind of businesses, you should just probably fundraise and scale rapidly. So that's one thing which I think I would have done differently. And the second thing is, I believe, I mean, this could be a little philosophical, but I think that I would like for people to be a little kinder to themselves. Back when I was starting up, there was, there was quite a lot of pressure for achieving quickly, and in that pressure, you tend to take yourself for granted, both mentally and physically, which is even more extenuated in hard times, like we've seen in the past 1.5 years. So I wish I and a lot of founders out there would be kinder to themselves and just be okay with just being in the process. Although I'm saying this now, I still feel a year down the road, in hindsight, I'll believe I'm being harsh on myself now. So I guess it's an ever-going process to try and improve while allowing yourself to derail once in a while. So two learnings, which was one, delay fundraising as much as possible, and second is just be kinder to yourself in the journey.
Thank you very much for the advice. And yeah, I think I don't know how do you imagine yourself, but I think in fintech industry especially, it's harder than in others. You have like the pressure of the funds. So I understand.
Yeah.
Um, um, what advice would you give to aspiring startup founders?
Okay. Got it. So I'm assuming this question is for someone who's very early on in their journey, right? I mean, technically, I also believe I'm quite early on in my journey. It's just been about 2 years. But for aspiring founders, I think one of the best things that you can do is to filter noise. And by noise, I mean there is so much unnecessary news, pressure. And in India, there's a very famous term that we use called gyan. Now, gyan literally translates to knowledge, but knowledge or wisdom. But in our context, gyan is basically something that you get from people. It could be investors, consultants, etc., on how to run your business or how successful they think you can be, etc., etc. Basically, a bunch of unsolicited opinions, gift wrapped in an advice, right? But the fact is that no investor or consultant knows your product and market better than you. You're the one who's building in the space. You're the one who has the most on-hands experience with it. So I believe you should have extremely strong beliefs, but you should use these opportunities when you talk to investors or consultants to constantly challenge your beliefs. So even though you have strong conviction on this product could work, you should often challenge yourself and your own thought process in by talking to these people. So it'll only help you filter out and probably distill your thought process better. So yeah, the first advice would be to filter noise. The second would be to have faith in data and your co-founder. Data and your co-founder, one should probably build your thesis and one should always challenge it, right? So that's a very important cycle to have, where you believe data tells you one thing, but there is an out of bias person who's a co-founder that's often challenging the next steps. So I think that's a very important cycle to have if you want to truly refine your business model. And the third is from a very personal experience. If you're pivoting, you should know why you're doing it. As founders, you are inherent builders and problem solvers. Although this is a great skill or outlook to have, it can also often derail you from what you are building. Everything looks exciting when your own product becomes hard, right? So there was this one time, I believe, when it was really difficult for us to find a licensed partner to integrate with. For context, in India, this is almost mandatory for any fintech to do if they themselves are not licensed. So when we were going through that hard period in finding the right partner, me and my co-founder would meet every day and spend an hour thinking of easier businesses to build. And whenever we thought of a good idea, we did the research and realized that, hey, each industry has got its own villains. It's got its own problems. And after spending / wasting about 7 to 10 days, we realized and probably remembered why we are building what we're building, and just decided to go through with it. That experience honestly made me realize that unnecessary pivoting often becomes an easy escape from hard execution. And my advice would be to, try to stick it out, go through with the hard tasks, because the other side is often really worth it. So I think these are some of the advices that I have for founders.
Okay, so filter information, have a devil advocate, somebody who can,
Yeah.
go against what you're doing, and unnecessary pivoting. Okay. Um, uh, are there any upcoming milestone or initiatives that you're particularly excited about?
Yeah, actually, there are a few exciting products that we're launching this year that would help our investors de-risk their investments even further. By investors, I mean our users. Um, Apart from that, apart from launching new products, we're also projecting to turn profitable before the end of the year. So that's going to be an exciting step for our
Wow,
business.
amazing.
And apart from that, we've got some interesting offers to expand into different geographies. But that's not something that we're actively working on. But yeah, I mean, if the time, cash flows, and the opportunity is right, we'd be happy to expand.
And my last question is about a more broader vision. So it's the last question. How do you envision your startup making a positive impact on your industry and on the society in general?
Right. So, Audrey, to be honest, when I started out, it started out with a very personal bias. I faced a problem which I thought could be solved better. But when you actually started building out, when you started having customer conversations, you actually realize that there's so much of a wider array of people that you can actually impact, right? So with Capitall, as time has passed, as our name suggests, we actually want to provide capital for all. We want to harness the power of retail investors in making capital more accessible and inclusive to the lesser served sections of society. Today, we're doing small scale businesses, but tomorrow, who knows? Maybe education loans in the future, maybe women empowerment, capital for women empowerment in the future. So with Capitall, we want to truly keep it open and accessible. And one thing is sure, no matter which direction we go in, the platform will be the most accessible and inclusive place on the internet for lending. Um, Hopefully, bridging the credit gap for India and the world, um, one investor and one loan at a time.
Thank you very much, Sanskar, for sharing your experience and presenting Capitall, a fintech enabling anybody to collectively lend to vented, high growth startup in exchange for fixed returns. Thank you for your time. It was a pleasure to talk with you, and I hope you will have a lot of yarn in the future.
Thank you so much for your time, Audrey. Hope you take care and have a lovely day. Bye bye.